All right, so I'm going to show you how to go look up financial statements on the sec.gov site. First, we go to Google, we look up sec.gov, we find the sec.gov homepage, click on it. We can see on that homepage for the U.S. Securities and Exchange Commission that we have quite a number of menus there. We want to go look for filings and company filings search. We're going to type in the name of the company. In this case, we're going to use Apple Computer as an example. So we type Apple Computer and search. Pretty easy. Now we get into the Edgar search results for Apple Inc. And on the left-hand side, we can see all the different filings. We're looking for a form, a filing that is called a 10K. 10K is an annual audited report. So 10K is an annual audited report. That's what we'd like to see. They also have 10Q, but 10Q is not an audited report. So preference is to have Form 10K annual report. That way we have audited statements for a whole year or a whole operating cycle. So we click on the link next to the 10K and it actually brings up the whole form. So here we can see it, and on that front page we can see notes that are due. And as we go down, there's different questions that they've answered. We get to the table of contents. So we're interested in the table of contents. We want to see what we have in there. There's a whole section on risk factors, comments. There's another section on management analysis, discussion and analysis, management's discussion and analysis of particular financial data, so selected financial data. We don't want to look at that because it doesn't give us all the financial data. Well, we do want to look at it, but we'll look at it later and see what they're saying they believe is going to happen in the future. But what we really want to look at when we go in here is the financial statements themselves, because we want to see the entire financial statement so that we can use ratio analysis or comparative analysis to see what's different or the same between them and their competition. So there we see financial statements and supplementary data. If we click on that, it takes us right into consolidated statement of operations. So it takes us to consolidated statement of operations. On that statement, we can see net sales, cost of goods sold, gross margin. We can see operating expenses as far as research and development for them, general and administrative costs for them, and we come up with total operating expenses. So we have operating income underneath the operating expenses. Then we have any other types of income that were not from operations. Maybe they sold a piece of equipment that they were using that was not part of their inventory. Then we have income before income tax. We have a provision for income tax, and we have the net income. Then you'll notice the earnings per share. Earnings per share would always be on the income statement or operations statement. We have basic earnings per share and diluted earnings per share. They also show us the number of shares that are being used. So you see the number of shares. And let's see. The big figure that we want to note on here is the actual net income itself. Because what we want to realize here is the net income is from one operating cycle, which for most companies is a year. And we can, that income closes out into the balance sheet. The income always closes out into the balance sheet annually and becomes part of history. So the balance sheet is a piece of history, whereas the income statement or statement of operations is just for a period of time, which would be one operating cycle. In this case, we take the net income and we can follow it into the consolidated statement of comprehensive income. The statement of comprehensive income is a bit different because it's got some additional items on it. Under generally accepted accounting principles, if we have marketable securities held as a resource on our balance sheet, then we need to adjust them at the end of the cycle to their value, to their actual value. So that consolidated statement of comprehensive income will show some of those value adjustments. So even though we haven't sold the securities, we have revalued them. We also can follow that net income figure, which is 45,000 something. We can also follow it into the consolidated statement of shareholder equity. When we see it on that shareholder equity statement, that's where we see it flowing into the balance sheet. Because the equity statements are giving us a reconciliation between the beginning of the year equity and the end of the year equity. So there's a number there, 45,000. We go back up, we can see that 45,000 up there on the income statement. So we see the 45,000 up there. We go back down to our equity statement. We can see the same 45,000. So this is how it winds up in part of history right in the balance sheet. Above the 45,000, you'll see 119,000, and that is the beginning of the year equity. And at the bottom of that column, you see 128,000, whatever it is, and that is the ending equity. Now, these statements were missing the zeros, so I'm leaving out zeros and I'm leaving out some of the numbers, so I'm just rounding things. But you can go in and look at this yourself, and you can see the change from the beginning of the year equity to the end of the year equity. This is giving you the reconciliation. The income is on there. The other adjustments that are on there might have come from the statement of comprehensive income, or maybe they paid dividends, because if they paid dividends, the equity is part of the owners or belongs to the owners, and maybe they've paid part of it back out to the owners in dividends. So we can take that and bring it into the balance sheet. So now here's our history statement. Our balance sheet shows assets, liabilities, and equity, and it balances. So the assets are equal to the liabilities plus the equity. The equity that we just reconciled came from the consolidated equity statement, and we can see that figure in there, the 128. Okay, so we can see the equity right on that balance sheet. Okay, so go back, there's the 128. If we look on the consolidated equity statement, we go back up to the balance sheet, and we can see the net income coming in from the income statement. We go back up to the balance sheet, and we can see the assets, the liabilities, and the equity. So again, the assets, the total assets, are going to equal the total of the liabilities plus the equity. Okay? Therefore, what we're really looking at is if we took the assets, we subtract out the liabilities, what's left over is the equity. The equity is what belongs to the owners or the shareholders. All right. The last statement that we would look at is the cash flow statement. And with the cash flow statement, the cash flow is a reconciliation between the beginning of the year cash and the end of the year cash. So when we go to the cash flow statement, we can see, and there it is, cash flows. We can see cash flows from operations, and again we see the net income coming from the income statement onto the cash flow statement, and then we see adjustments from that income to bring it into the actual cash that came in, right? To bring it into the actual cash. So we're pulling, first of all, on that cash flow statement, we're pulling the net income and we're putting it down there on that cash flow statement, because we're going to reconcile that net income out to what was actually cash received or cash put in. Okay, so we start with beginning cash though, And the beginning cash is last year's ending cash, right? So if we went to the balance sheet and we have two balance sheets showing, we can go to the previous year's ending cash, and that would be our beginning cash for this year. So we have the beginning cash from the balance sheet. We also have the ending cash from the balance sheet. And let's see, we'll go to the cash flow statement. There's the column for the beginning cash for the cash flow statement right there. And we also, on that cash flow statement, have the ending cash flow. So if we go down the bottom of the statement, we see the ending cash flow. If we go back up to the balance sheet, we can find the ending cash on the balance sheet. So once again, we go back up to the balance sheet. We can see the ending cash. So what's the cash flow statement? It just reconciles the beginning cash to the ending cash. What happened with cash during the year? Where did it go? Who used it? Did we use it in operations? Did we make cash in operations? Did we use it to invest in some other companies? Did we use it to invest in equipment? What did we do with it? That's what the cash flow statement will tell us. So the cash flow statement has three sections. It has cash from operations, it has cash from investing, and it has cash from financing. So we would first like to look at the cash flow statement and see if there was positive cash from operations. That could be a really good sign. We like positive cash, right? We also look at the next section, which is the investments. Have we invested in any other companies? What are we doing with the cash? What's happening with all of this cash that we're investing? Are we buying new equipment? Are we doing research and development? What are we doing? The last section there is financing. Where are we getting extra cash from when we're doing projects? Are we selling more equity to more shareholders? Are we borrowing money? All of that would be in the financing section. The net result of those three sections is the difference between my beginning of the year cash and my end of the year cash. And so that's why you see the cash at the top of the statement, cash at the bottom of the statement. So I can take the operations cash and add or subtract the investment cash and add or subtract the financing cash and come up with the net difference. And that all should reconcile right into that balance sheet, which is my history, right? Because everything stays in the balance sheet forever once it hits the balance sheet. Of course, it's used. I mean, the balance sheet keeps changing, but history stays in that balance sheet. We also see on the cash flow statement any cash that was paid out for taxes and any cash that was paid out for interest expense. So shareholders like to see, did we really pay out any cash in those items? After that, we'll see notes to the financial statements, and the notes are integral to the financial statements. And there's many, many notes. The beginning of the notes usually tell you about how the company reports. The following notes give lots of details. They might give details on depreciation, on leases over the next 5 or 10 years, on debt over the next, 5, 10, 20 years, whatever it might be. All kinds of notes in there. Gives you a lot of good information on the company, what they're doing. It'll probably tell us about any investments that we, if we saw money going out on the cash flow statement, we'll be able to find someplace in there, what are they doing with it? So notes, really important. If we go back to the index at the beginning, then we can go to management discussion and analysis and take a look at what financial figures management pulled out to look at and what they're predicting as we go into the future. So management discussion and analysis is a required part of the annual report, and it's a very interesting part. So, take the time to read it. But just realize that when you look at the selected financial information there, it's not what you should be using to do your ratio analysis. You want to use the full financial statements. Let's see, there's also in statements a note if there's any disputes with the auditor, because these are audited financial statements. So when you see a 10K, you've got audited financial statements in there. So it's nice to go out to that note and see if there were any disputes. In this case, it says changes in and disputes with the auditor, there were none. So, good sign. And then once we've looked at all this information, then we like to know what do the auditors think of the company's financial statements, because the financial statements are the responsibility of management, not the responsibility of the auditor. The auditor just forms an opinion on whether they believe that they are not materially misstated. The auditor's job is to, review them and see if they are in alignment with generally accepted accounting principles. The auditor will also give an opinion on internal controls, which management is responsible for setting up internal controls to protect the resources of the company. And basically, the Securities Acts were set up in 1933 and 1934, and the 34 Act set up the SEC. The reason the SEC was set up was so that investors would have confidence in the financial reporting and would feel confident in investing in the financial markets. So that goes all the way back to 33 and 34, amazingly. So look at the auditor's opinion. Notice the first paragraph. It'll tell you what statements were audited. It'll say that the operations statement is for a period of time, because it is for only a period of time, and that the balance sheet is as of a certain date, because again, the balance sheet is history. So it'll say the balance sheet is as of. Then you can look at the other paragraphs in that report. Apple has a nice clear report, so it gives you an idea what the report looks like. The second paragraph basically says that the auditors use generally accepted accounting principles to review the statements, and AICPA audit standards. And I'm not wording it correctly, but look at the wording in there. You can see the wording. And then the third paragraph gives their opinion. So that's a Form 10-K that you would find on the SEC site for a public company.